Thank you all for coming here on a nice cold day through the capricious checking in process. We're lucky to have three distinguished panelists today. I was first going to tell you a story, begin with a story of elephants, accompanied with a picture, and I forgot to send the picture along, so I wasn't going to tell the story. And then Antonio reminded me that he was quite curious about the story, so I'm going to go ahead and tell it anyway. There's an ancient Asian story about 5 blind men walking along and coming across an elephant. The first guy touches the tail and says the elephant looks like a snake. The second guy touches the ears and says, no, it's nothing like a snake. It's more like a fan. The third guy is touching the body. He said, oh, you guys are just bullshitting. It's more like a wall. And so it goes, right? With the picture, with the colorful picture, it looks great, and there's a poem somewhere on the web. So if you Google a story of 5 elephants in blind men or elephants in blind men, you'll come across very many versions of this story. Risk is like an elephant that we all have different perspectives on, and to effectively judge risk, we need to look at the risk from multiple perspectives, because we are, after all, blind people. We have 3 distinguished panelists who are going to provide 3 distinctly different, and they're experts that have some commonalities, but Sebastian is essentially a very intense, focused equity risk expert. Antonio, and of course he knows other stuff, right? But his company right now is peddling one of the state-of-the-art equity individual instrument specific risk models. Antonio takes the game a little bit from a different perspective, starting with fixed income kind of specialization, working with Lehman's clients, managed to broaden the asset class coverage to a broader set so that a multi-strat and global macro fund can effectively use a risk engine. So we'll get a second perspective from Antonio. Ron, on the other hand, let me see his bio. He's an expert on Italian clothes. He represents Risk Metrics. He's been around for a long time. And not only the quantitative, so Risk Metrics Group has evolved from providing quantitative perspectives on risk to incorporating governance and fraud risk and so on and so forth. So he might have yet another perspective. So we are lucky to have 3 different perspectives from the guys who are at the top of their game. The way we are going to do this is actually each of the panelists would start with their preliminary comments. I requested them to provide us with a perspective on how the risk business is done from their viewpoint. So their initial set of remarks might be focused on risk issues, and then they'll follow up with the next set of remarks on risk business. And then we'll open up for the audience comments. With that, we'll start with Sebastian.
Thank you. I have a few slides that I put together, and I plan to go over them rather quickly. The idea is to talk, like Sandeep said, from the risk management perspective of the equity portfolio manager. What are they seeing, what is different, and how they're changing their business and their business practices. So, first of all, just to put things in perspective, let's talk about how do equity PMs use risk models. When they think about risk, they use risk models, first of all, to estimate the predicted risk of the portfolio that they're managing. And this could be total risk if it's a long-short strategy, or it can be tracking error. And in the next column, we say, well, how frequently do they do this? And they either do it daily or monthly. Second of all, they try to go deeper, and that is not only understand what the headline number, the predicted risk is, but actually what are the sources of risk for their portfolios, and this is what we would call risk decomposition. And they tend to do this analysis on a monthly basis. Next, they go ahead and they try to understand where the performance is coming from in the portfolio. And they use a risk model to do factor-based performance attribution, so understand what are the sources of return in the portfolio. And they do this on a monthly or quarterly basis or whenever a client requests so. The next thing they do is they actually use risk models in the context of portfolio construction. So in this particular case, what they're doing is they're putting together a risk model and an optimizer and an alpha process to actually get an optimal portfolio that sort of optimally trades off risk and return. So you need a risk model to estimate risk, and you obviously need an alpha to estimate predicted return. And they do this typically on a monthly basis. Is the active equity portfolio managers of the traditional asset management houses do this on a monthly basis. And then finally, and this is more driven by the circumstances that are going on in the marketplace, sometimes equity portfolio managers try to actually figure out how they can hedge the risk of their portfolios. So these are some of the uses that risk models actually have in the equity risk management world. Now, what happens during a crisis, and what happened during the crisis that we saw in 2008, and we continue to see to some extent in 2009? Well, what happens is volatility rapidly changes. So we were in a regime of pretty low volatility. Suddenly, volatility starts increasing, and when it increases in a hurry. And so, suddenly whatever they thought was the reality has really changed. Second thing that happens is also not only volatility increases, but the structure of volatility increases, and correlations rapidly change. So things that used to be positively correlated sometimes become negatively correlated, or things that were barely correlated become highly correlated. So the structure of how this volatility manifests itself in the market is actually changing. And factors during this crisis tend to drive more of the risk, except that those factors may be different factors. So, during the crisis, it may be that actually liquidity risk plays a much more important role, and those factors are the ones that are driving the volatility increase in the market. And sometimes also what happens is that the assumptions we make about asset returns, go out the window. So, we typically focus on second moments, but third and fourth moments and skewness and kurtosis start becoming important and relevant for actually the way that we look at risk. So that's what happens during the crisis. So here I have just a slide that shows some of the changes. When you look at Axioma's factors, you see some of the changes in correlations when you go from 07 to 08 to 08 to, in particular the time periods from the beginning of the crisis until the Lehman collapse in the middle of September of 08. So what you see is that some positive correlations, for example, medium-term momentum to market sensitivity, and others become negative. Some small correlations become larger. But basically what happens is that the structure of risk is actually rapidly changing. Here's how the VIX prediction changed. I mean, you see that wall in terms of risk predictions and how it rose and how it rose in a hurry. And then, of course, the other part that you see coming out of the crisis is that when volatility drops, it also drops very, very quickly. Now we're in levels of VIX of 20, whereas a year ago we were in levels of 80 or 90. So clearly that volatility drop also becomes very sudden, very quickly. So the question is, okay, what do PMs do during a crisis? What should they be doing, and what are they actually doing? So one of the things they do is they actually decide to monitor the volatility or the tracking error of their portfolios much more frequently, right? So the idea is they used to think or look at these things on a monthly basis. Now the world is rapidly changing, so you want to do this on a daily basis. And the challenge is that most commercial risk models which are available out there don't really update the risk models on a daily basis. They update the risk models on a monthly basis. So if you really want to look at this volatility changes intra-month, you're in trouble because effectively your volatility estimates are out of whack. Not only you're in trouble intra-month, but then at the end of the month you're going to have a big surprise, right? Because That there's going to be a change in volatility. That change in volatility estimate is going to be sudden and it's going to be extreme. The other thing they want to do is that they know that when there is a crisis, traditional methodologies for measuring risk may actually not provide them with risk estimates that are accurate. So portfolio managers that are used to fundamental models may actually want to look at a statistical model to see how risk is behaving when you don't look at fundamental factors, but look at factors that rapidly change during the, with the market. And then finally, they do something, which is not only they look at things, but now they want to act. And when they want to act in a hurry. And when they want to act typically to reduce the volatility of their portfolios. So they're going to try to rely on these risk models to actually, make a change to their portfolios. And what happens there is because many people are acting, because at the same time, because risk is really dominating that trade, and because many portfolio managers use similar risk models, what happens is you have a liquidity crisis because effectively the risk model is driving most of the portfolio managers towards the same trades. So these are the things that happen during the crisis. So to some extent, the existing risk tools exacerbate the problems that the crisis brings to bear. So one is because the estimates are not timely. Two is because everybody wants to act at the same time, more or less doing the same thing. During a crisis, things that are bad enough get even worse. So clearly, when you want to address or retool the risk model offerings, you have to deal with all of these issues. So what are portfolio managers that recognize these issues trying to do today? Well, is first of all, they're asking that some of these issues be solved. So the first thing they're asking is that risk models be updated more frequently. So, we do that, and other risk vendors are actually moving towards providing updates on a daily basis. It's very important that, risk estimates are timely. Second thing they're asking for is they're asking for different views of risk. So other than saying, well, you have to be religious about whether you like fundamental risk models or statistical risk models, is during a time of crisis, give me as much as you can, because I really want to look at risk from different perspectives. They want to consider higher moments. They want to stress test their portfolios. And when there is a crisis, they want to avoid crowded trades. So these are, sort of the problems being recognized, and obviously PMs asking people like ourselves to do something about it in terms of trying to change the status quo. What I have next is just a few slides that showcase a lot of these problems, so I'm going to go through them pretty quickly. So this one shows that for an active US strategy, how a statistical model risk prediction is very different from a fundamental model risk prediction, and how you see that during the height of the crisis, actually the statistical risk model did a much better job of predicting active risk than the fundamental model did. And you see how, as the crisis subsides, the two models go back to providing very similar estimates. This slide is similar for an emerging markets, but it's more pronounced because it shows how the estimates were going together, and then at some point, the estimates vary pretty radically between a statistical model and a fundamental model. This one is a very interesting one. This shows the difference between daily re-estimation and monthly re-estimation. So what you have with the large jumps is what happens if you update the model once a month. And what you have with the blue line is what happens if you update the model intra-month. So obviously you'd like these changes to be smooth, and what you see is that they're quite smooth, but what you also see is that there's huge jumps, and those huge jumps lead to big surprises for most portfolio managers at the end of the month when they actually have to act in a hurry to significantly reduce the risk of their portfolios. This shows actually how during the crisis, more of the risk is actually coming from style factors rather than industry factors. So you see as risk increases, how much more of the total risk of the portfolio is being captured by the risk factors. One thing which is important to always remember is that our job is much easier than the portfolio manager's job, in the sense that we need to capture the volatility of these factors. We don't necessarily need to capture the direction of these factors, right? So the portfolio manager is actually trying to figure out if momentum is going to go up or down to try to make money. We just need to know how volatile momentum is going to be. So our job is a lot easier than the portfolio manager's job. So we could be doing a good job in risk prediction, and the portfolio manager could actually be doing a pretty crappy job in return prediction. This one shows actually a phenomenon which is very, very important, which is this notion of volatility going up in a hurry and coming down in a hurry. So what do you do about having risk estimates that actually adapt to those changes in volatility regimes? So typically what people use is exponential weighting. And the problem with exponential weighting is that exponential weighting really weights the recent observations more heavily than the prior observations. And when volatility is rapidly changing, that may work if volatility is going up, but certainly doesn't work when volatility is coming down. So risk models tend to lag. The volatility estimates tend to lag for a long time. So right now, people are complaining a lot about risk overestimation rather than underestimation, right? So risk models don't get it right when it goes up, and certainly don't get it right when it comes down. So one of the techniques that we invented is this idea of adapting your volatility estimates by trying to figure out in what kind of regime you are, whether volatility is going up or volatility is coming down. So this is an example of a risk model that contains this technique versus one that doesn't contain it. And the last one is a further example of the same issue in total risk. So I hope this gives you a sense of some of the issues that we're being asked by our clients and some of the main observations that we're having around risk and what we're trying to do as a risk provider to obviously try to address this issue.
You have slides? This one's
I have slides, yeah. Here they are. So the presentation the quick presentation that I had prepared basically gonna hit 3 different topics. One is gonna be basically what our conversations with clients yield in the last year. Second one would be our own perspective about things that worked well on the risk models, things that did not work well on the risk models, and lessons learned from there. The third one is looking forward, what our clients what are clients requesting, and what has been some parts of our agenda that we find particularly interesting. Okay, so regarding the clients' reactions, and basically, if we put it on a portfolio construction simple framework, return on risk. The first thing that, of course, everything, everyone refers to in terms of misprediction was liquidity. Liquidity. If you ask them 5 times, they will say liquidity the 5 times. And obviously, we can debate then where that liquidity came from. But that's basically the major point in terms of return. Of course, this liquidity is highly related with the fact that what they thought would be alpha is not so much alpha. What they thought would be a nice inventive idea is not so inventive because a lot of people are doing the same things. And in a certain sense, I think it was everybody knew a little bit that everybody was doing a little bit the same thing. But the idea was that when I need to unwind, I will be able to unwind more or less peacefully. And that's where the liquidity crash came in, when everybody tried to unwind at the same time. The second point is that they're getting a little bit more inventive, clients, regarding alpha strategies and how they, basically how they set up their models. And I think one interesting point that comes to the risk component also is not so much that they are inventive, but they are a little bit more cautious about what are the quants, the quant analytics that they are using. And for instance, things that they would take for granted, like sensitivities to change in oil prices and stuff like that, that they are much more skeptical about it. The fact that you have a number, it doesn't mean that that number makes any sense. And that again comes to the second point, that is around risk. And around risk, what we have been seeing actually is a very intense increase on the risk use, and I'm sure that's the truth for everybody here. The risk models are not bad, but by the contrary, during the crisis there was a very increase on the use of risks. But I think the nuance is a little bit different. People understand that the risk models will not give you all the answers in all the circumstances, so it's important to understand well the models. What are the assumptions behind the models, and what are the conditional information that the model uses to predict that forecast, so that they understand better If the model fails, why it's failed? It's failed because it's a bad model, or it's failed because the conditional variables were forecasted on the wrong way. And it's also much more about knowing the people behind the models, understanding the breadth of the research that the group does, understanding how state-of-the-art that research is, bouncing back ideas, many different ideas around research. What is the track record in terms of implementation of changes? Why are we changing models? And lastly, how close we are to the markets. Do we understand when we talk with traders, with PMs, do we understand what they are struggling with? Do we understand what's going on with durations, with IOs, with POs, with all these different sensitivities, prepayment models, and all that? So this is something that I think all of us here would feel as a blessing, that these people really are looking at the models and try to understand much more what the models are saying. Then I'll change to a different topic, that is what went wrong. And what went wrong, in a certain sense, the easiest way is to go to volatilities. Volatilities for a lot of the asset classes were really off. Okay, really off. And I'm posing there a graph just for illustration for the CMBS market. And they went very off, not so necessarily because the risk models were bad. Risk models have historical data behind them. It's more because the markets, in a lot of senses, the markets completely changed. If you look at the graph on your right, I think, the graph to your right, you will see that during 10 years, the light blue line that you see there is excess returns of CMBS over treasuries. You see that over the last 3-4 years, let's say 2004, 2005, 2006, 2007, the average volatility was around 20 basis points per month. And then you move forward for the last year and a half, 2 years, and then the volatility went from 20 basis points to 5-6%. So it's basically a complete shift on the asset class from something that was close to an agency, not in terms of behavior, but in terms of volatility, to something that is almost like equities. And so this is something that you would see on a scenario analysis. Probably very remotely. It's definitely not that you want that you would be able to have on a risk model. There are many other things that went bad. The total collapse of the idea of idiosyncratic diversification. Obviously, this was not an idiosyncratic crisis; it was systematic. And so, people that find some comfort on those constraints were not better than anyone else. And of course, correlations, hedges, basis risk, and all that stuff, very hard to pin down during the crisis. There's a lot of things that went well also, fortunately. And I would point very clearly that the things that in our models work very well was models in which we use a lot of conditional variables. And I want to emphasize that conditional variables don't need to be daily data only, although our models do use a lot of daily data. But it's basically trying to, when you design the model, try to design the factors. You would identify the factors on an economic sense that makes sense, but then trying to estimate those factors in a way that you get the most invariant factor possible. And so a lot of the shift goes from the factor also to the loadings. And of course, then you can apply loadings on a daily basis more frequently. Also, you can do a lot of scenario analysis regarding those loadings. Finally, I would say on the cross-market feedbacks and loops, that's something that gave a lot of robustness to a couple of our models. For instance, equity and credit risk. The fact that we use cross-information between these two markets basically increased the robustness of the two markets, and that was something that our clients really felt. I have here a couple of slides that I'm going to pass by in terms of things that went well. What are clients looking for? The answer is also very unanimous. Measures of liquidity risk. and scenario analysis that makes sense. What other interesting points that I think that we think are overlooked in our group is the synchronicity across the asset classes. So for each individual asset class, you will develop models that try to address as specifically as it can the risk on that asset class. It's very dangerous when you have big swings as you had in the last year and a half, that just because of modeling choices, one model, let's say, it's updating faster than the other, and so your optimization or whatever you use is basically shifting your allocation towards basically the asset class that is updating less fast, and that's just because the models don't speak so well with each other. That's a big concern that our clients have. Is a big concern that we have also. Another, and just to finalize, another one is, of course, asset class correlations. So correlations with asset classes, how conditional we can make them. There's a lot of academic literature around that. Of course, the devil is on the details on how you would implement those things. I would stop by here.
I don't have any slides, but I do have some general comments that I'd like to make about what we're seeing from our clients in the risk space in terms of specifically what has changed and what our clients are looking at today, and specifically over the last year. But before I immediately address the risk space, I'd like to address what has actually led up to some of these changes, and that's some of the fundamental changes in the investor and hedge fund space. And there's been a shift, as many of you know, in the balance of power. It's not necessarily a complete shift, but there's a sway in the sense that, or it's been a shift more towards investors from hedge funds. And the fact is, investors have much more influence today than they did 18 months ago. And that has actually created a greater impetus for investors to request changes, to request specific risk management conditions around their investment strategies. And that's been a big driver of some of these changes. The other change that's happened specifically over the last year is the focus of hedge funds. While over the last decade, there was a shift from single strategy hedge funds to multi-strategy hedge funds. Hedge funds were taking advantage of the fact that investors were looking to diversify, and if they had a good name, they could expand into a broad range of strategies and gather assets. Essentially, what they were doing is being a quick stop for a fund-to-fund, or they were offering fund-to-fund-like investment opportunities directly from the hedge fund rather than having to go through a fund-to-fund. This trend that we saw over the last decade actually started to reverse last year. And what we're seeing is now a much greater focus on core competencies. So many of these funds that expanded their tentacles and reached out into broader areas are now retracting and focusing specifically on the areas of risk management, or I should say the areas of investment that they have a history of doing well in. And you could argue that this is there's been a recognition, not just among investors, but among hedge funds as well, that diversification alone is not a sufficient risk management strategy. And recognizing that diversification still has its benefits, but to rely solely on that is not necessarily ideal. And this focus on core competency is something that we're seeing directly from the hedge funds and really across the investor space. So what this leads me to now is some of the changes that are happening specifically in the risk management space. For starters, let me address some of the changes in just the focus. Now, over the last decade, there was significant focus on models. There's a common phrase that says the average risk manager studies the models, the expert risk manager studies the assumptions. And what we've seen is there's much more focus now on the assumptions rather than the models. There's been a lot of criticism of the models, and I'm not here to argue whether or not the models are right or wrong. What I'm telling you is that what we've seen is a much greater focus on the inputs into the models rather than actually changing the structure of the models. And now that there are some models that are being modified and improved, and I think they will continue to be improved, but risk managers have had a significant, they've taken a step back and said, what is going into these models? And that's quite a dramatic change, I would say, and that is specifically instigated by the volatility in the market over the last year. Another area where we've seen some significant focus is on an area what I would say is the corroboration of data. Essentially, the triangulation of multiple points. And let me tell you exactly what I mean. We have investors that are looking to compare the risk of their portfolios with the return of their portfolios. These are investors that might not have access to their portfolios. For example, an investor in a hedge fund may not have access to the positions and understand what's happening. But what they do have is access to some of the risk statistics. And they can actually corroborate the risk statistics, essentially running simulated returns. When I say simulated return, I mean literally a 1-month historical stress test that would show the changes of that portfolio over the month, and compare it to the P&L returns, that the actual reported P&L of the hedge fund. This is something that started, or I think started to get a little popular around the Bayou period, when people said, well, how can these returns be so smooth when the market's not? So this whole concept of actually validating the returns, corroborating the returns with the underlying positions in the portfolio. So this is something that investors are looking at, but we're also seeing this same type of a focus within funds. So managers within hedge funds that are focusing, that have positions, that have access to the positions, know exactly what their P&L is, are actually comparing their risk numbers to their P&L numbers. So they're looking at VAR numbers and other risk statistics and comparing it to their P&L numbers. And not on a traditional backtesting methodology, but to specifically identify whether or not they're consistent in their performance. And this whole idea of getting data from multiple sources and checking whether it makes sense, whether it actually all adds up, is something that we're seeing a much greater focus on. And it's not specific to identify fraud. It's really to identify whether or not you have a fundamental understanding of the risk within a portfolio and whether or not the assumptions that you're making are legitimate. So these are steps that we're seeing investment managers and risk managers focus on a lot more aggressively. There's another term that's come up over the last year, you've probably heard of it, reverse stress testing. It's a term that 2 years ago you probably never heard, and it essentially didn't exist. And this is an area, by the way, maybe I should define it. There's probably, I can give you a definition. I can guarantee you that you'll have heard of another definition as well. There are multiple definitions. People tend to use different definitions here. One definition of reverse stress testing is, you may have heard also a term, portfolio-specific stress testing. That's where you take specific information relative to the portfolio, relative to the business, and incorporate that into the risk management techniques. So I'll get into more detail on that. But that basic concept of not just running risk reports independently, but running them in context of the business and specific sensitivities within the business is part of that process. Another simple version of reverse stress testing would be running a stress test, but running it in reverse. And what I mean by that is a traditional stress test, you take a stress test, you shock the market, and you look at a P&L. A reverse stress test identifies a P&L threshold and then goes backwards and says what particular shocks to the market would actually trigger or generate that P&L. So it's approaching it from a different side, but what happens is you can get quite a broader range of results. And the benefits to this type of analysis, ideally, is that you're incorporating information throughout an organization. So while risk management or risk managers are often thought of as operating kind of in an island, in an isolated area, where they run risk reports. I'm shocking the S&P 10%, or I'm raising interest rates 50 basis points, and I run a set of reports, and then you produce that data, and that's an isolated set of data. A set of reports is distributed throughout the firm. But a reverse stress test would use a completely different approach. It would say, how is this firm or fund vulnerable? So what are the particular thresholds of vulnerability that I need to go test my test market shocks for? And it's this whole approach that we're seeing a much greater focus on today. One particular area, certainly that reverse stress testing has gained a lot of legs, is specifically in the area of contagion. Regulators have focused on contagion, and those are the things that they're trying to get a clearer picture on. And this whole concept of identifying trends that are consistent across an industry, it's not just knowing how much each firm loses with a particular shock in the market. It's identifying firm sensitivities across a whole industry. This is an area that we've also seen a significant amount of focus. I know there's a lot of questions we'll go into, so I'm going to actually cut my comments there. But I just will make this a general statement around contagion, crowded trades, and systemic risks. And the area that we're seeing a lot more interest is specifically around the transparency. That is identifying holdings not just of managers' own positions, but the holdings across the industry. There's a lot more focus now in terms of getting that information. It's not information that's easy to get, but it's an area where we're seeing a lot more interest. And I think it's going to be an area where, given the focus, there's going to be a lot of opportunity there going forward.
Thank you all three. I'm going to change text a little bit. Just by show of hands, just trying to pick up this audience. How many of you want to get into the next round of comments on business kind of side of risk? And how many of you want to start question and answer? So by show of hands, how many of you prefer going to question and answers? Raise your hands. Or you would like Q&A? You want to listen to these guys for another half an hour? Are you guys going to ask questions, or should I ask them first question? And they will go on for another half an hour.
You can tell us another story about elephants.
Oh, my stories are not very interesting. I guess there are not that many questions. We'll start off with one question, and then maybe we can get some more questions from the audience. So, to all three of you, one of the questions I wanted to ask was to notice kind of a crisis like 1997 Asian crisis, or 2001 crisis, right, or 2008 crisis. Do you think we need actually risk models or other things kind of that people can just observe right on the street or in their common experience, that they can see and feel an upcoming crisis?
I personally think crises are impossible to predict. I mean, you can just argue that there's going to be some, but it's very hard to know when and how. I think what is important is what people do during the crisis. And I think the challenge is that when there is a crisis, people tend to reduce their leverage. They tend to reduce their volatility, and that means that the trades get crowded, and then there's a liquidity risk, and there's the problem that feeds itself. So I think it's not so much that we can learn something about predicting crises. I think people that can tell you that are not, sensible. It's we need to learn what we need to do during the crisis. That is important. And sometimes relying too much on risk models or optimizers, or just let's do what the model says we're going to do during the crisis is the wrong decision.
I'm going to shift to Ron and then we come back. Sure. Should be right up a little bit.
Well, I do think that there's two different types of crises, and certainly a September 11th type of a crisis was one that would be extremely difficult to predict. However, there are some type of crises, specifically the housing bubble, which was not too much of a shock. and maybe you didn't picture, maybe you didn't know exactly when it was going to go. But for example, if we were here in the Northeast, the bubble in housing prices, we saw it pop on the West Coast or in the South first, in Arizona and Nevada. So we had a full, over a year head start in getting a clue. And maybe there were other things it took to actually trigger it. But there are some things that we can certainly get an insight into.
I thought actually the internet bubble was a lot easier to predict, because I could order Indian groceries, right, for next to nothing. They'll show up on my doorsteps. And if that's not an evidence of kind of something weird, right? Go ahead.
No, I took advantage of Cosmos and Urban Fetch as well. So if whether that was a symbol of of the internet bubble or not, it was as an outgrowth. I would agree with you, though. I mean, your point that the internet bubble was also potentially recognizable, I think, is fair. The hard part, though, is not identifying that you're in a bubble. The hard part is identifying when you want to get out.
Right.
And the thing is that, we saw this in oil. Oil hit 100, and people, there was a fairly universal knowledge that this is a bubble. But oil got to 140. So if you shorted it at 100, you probably were taken out of the trade very shortly afterwards. So the hard part is timing it. But the point is that we can identify that these assets are more dangerous. Right. So, and I do think it's worth saying that while it's very hard. You can say you can predict a bubble, and timing it right is very difficult. But I do think it's fair to say we can identify it even if we can't time our exact entry or exit point.
Now you put Antonio in a really tough spot.
No, I think I cannot talk too much about past crises.
Right.
The past crisis, I was doing my PhD, so I had no clue of what's going on around the world. But I think that there are two important comments. I would agree that it's almost impossible to predict the crisis. Not so much that the crisis is coming, but what is coming from, right? So a lot of the clients, of course, and I remember that very well in 2005, and then 2006, and then beginning 2007, saying, I'm really scared. I'm really scared. This can only go one way, which doesn't mean that they know what is coming from and how they should position their portfolios, right? So that part is very hard. I would also argue that the evolution on the risk modeling it's an important one, and we are probably now more apt to react to the situation than what we were before. Of course, the situation gets complex, the risk models get complex also, but I think the evolution on the research is also important to highlight.
If anybody has a follow-on question, I have a follow-on question if you guys. One only for people who ask questions. Yep.
I have a question regarding the reverse stress test. So basically you are saying you set up the threshold for the risk you are going to take. So run your Monte Carlo simulation, so it's their possibility have like millions of possibility have the same risk. So what is the real risk?
Okay, well, by the way, this could potentially be an extremely long answer, and I don't want to make it that because there's a lot of different approaches we could use. You could use historical stress testing and use that reverse framework. You actually can pull specific dates out that you get stories for. You can there are general macro level sensitivities that you can run on a reverse stress testing framework where we identify specific areas of sensitivity, whether it happens to be currency levels, interest rates, or equity levels. There's a lot of different sensitivities that we can focus on within the reverse stress testing framework. But the concept really is about identifying the thresholds within an organization where it's vulnerable. So while traditional stress testing identifies how you make or lose money, reverse stress testing works around the area of what puts you out of business. So you identify the particular loss levels that could drive you out, that could put you out of business, and then you find and you run your scenarios to identify and potentially identify the plausibility of those scenarios occurring. And it's a process that doesn't just start and end with a risk manager. It actually starts with a conversation that a risk manager has with the CFO or the CEO of the organization, whether that's a hedge fund or a bank or whomever. It's about understanding what the specific vulnerabilities of that firm are. Not how much money they're going to lose at any one particular area, but it's what are they most vulnerable to. And when I say most, I don't mean on a dollar basis, I mean on a business basis, and then convert that into a loss level. So it's really about that type of a process, and I think people are starting to focus on that a lot more now.
One of the anecdotes was that if a hedge fund loses more than 10%, irrespective of how much the market goes down, or if it doesn't give you more than 50% of the return, then that strategy is a risky strategy. You get out of business. Because people either compare returns to the market return, and CSFB economy did a multi-year study about 8-10 years ago to identify client preferences on what are the pain levels where they would withdraw money from the funds. So it's that kind of identifying levels at which the assets can just flow out of the door, and then the factored exposures that might lead to those kinds of losses.
A very simple example, let's say you have a loan covenant or some kind of a bond covenant, and if you lose more than a certain amount of your assets, or you have a margin call at a certain point, well, a margin call could trigger further selling of your portfolio. So that's a very hard threshold that is specific to that fund. And using that dollar loss threshold to run stress tests and figure out what could actually cause those losses, that's really the process of running a reverse stress test.
I see a question from the back first.
I'm just wondering, are any portfolio managers actually using that approach to question their own ability to use portfolio manager? For me, at what loss level do I lose confidence in my own ability, therefore I have to reevaluate my skill as an investment manager? And do they still set a target of what the losses are? Have any of you got to be that humble yet?
Well, yes and no, right? So you've got a lot of literature on drawdown control, right? Ex ante as well as ex post. So a lot of people do follow Grossman's approach, right? And say that irrespective of how much confidence I have in what I do, once I reach certain threshold level, I'm going to start cutting my exposures. But at that point, I just don't know. So I mean, that is a systematic behavior.
Okay, I'm combining several of the ideas that were mentioned because I see a partial contradiction. I'm wondering where some things are coming from. First is, if we're using a measure where we're talking about on average, you would expect to see a loss no greater than some number, all but 5% of the time, or 95% probability as the world states it. It tends to mean that, assuming that everything stays the same, that in fact, if we were to see that number 12 to 13 times during an average measuring period, we should not be surprised. It doesn't necessarily mean that we can pinpoint when those are going to be. On the other hand, we're going to start demanding that our measurements, in fact, we can actually look at the changes in our risk versus the changes in our P&L. Then we're also demanding that, in fact, whatever bets we're making on the market coincide with those time frames that we're trying to guess. If we're talking about daily and a trader puts on a position that they're thinking about for a week, we can't talk about P&L for all of your total positions of being just over that one day. So I have a bit of a problem with, one, looking at either daily or weekly or monthly movements of risk relative to specific P&L. The next question comes from the fact that if we know we have a one-to-one issue where we're saying, well, we in fact have some risk, and this should in fact give us some return, or this return is due to this risk, or this return, of course, can be a loss, Now, if we're going to have this loss and we're trying to find what caused it, and we're looking for many to one, how do we know when we're done searching? And how do we know if any of those things we come up with, in fact, is what caused our problem?
You want to take it?
Yes. I'm thinking that the second one is more for the reverse testing. But in what regards the first one, I guess if I understood well the question, is a question of frequency. You're right that if you're rebalancing your portfolio, let's say for exaggeration every day, you can never test what was the distribution of that idea that you had for one day. But of course you can test on average, what is the distribution of your ideas. And so if you would rebalance on a daily basis, of course, you would measure that on a daily basis. If you rebalance that on a monthly basis, you would look at the risk models that tends to look more over that period. But I don't think there is any contradiction there. It's just a fact that if your ideas are evolving very fast, as long as you have a distribution for each idea, of course you'll have one realization from that distribution, but over time you can figure it out. If you're measuring well the distribution of your ideas.
Which is when we ask investors or when we ask our clients, what's your investment horizon? They talk about 6 months to a year. But then if risk changes rapidly in a month, they just want to do something about it. And so even though their time horizon may be 6 months to a year, the reality is the investors don't have that kind of patience. And they have that patience if everything goes well, but if things don't, they won't act. So there is really this contradiction between what's really your investment horizon and what's reality. And reality is that when, especially in the context of a crisis, people don't have 6 months to a year to wait. So they want to do something, and they want to do something quickly. And that's why I was saying before that it's important to learn what you do during a crisis. And what you do during a crisis is you throw a lot of your assumptions out the window. And you tend to act very fast, and sometimes irrationally.
Wouldn't it be useful to ask the clients up front and present these concepts that if this unravels?
I think it's wishful thinking. I think that the answer is yes, but I think it's wishful thinking. I think at the end of the day, the investors are just going to run out the door and everything is going to stop.
Well, you want to take it or do a couple more questions?
I'll just say one thing. You made a comment that you expect to get 12 or so accessions in a year, and so you don't. So what does that tell you? That's exactly what you'd expect. I think what happened over the last year, for example, or 18 months ago,
happened every 4.5 years, actually.
Or exactly every so often. But what people saw was that they had 10 months or 11 months of no accessions, and then they had 12 accessions in 1 month. Now, you could argue that yes, on average, that suits your suggestion. However, I think it's pretty clear to say that the assumptions used at the first 11 months were incorrect, as they were incorrect in the last month as well. And that's what, and really, there is some insight into looking at the data that way. So, I'd be cautious in terms of what conclusions you make, but I wouldn't throw in the towel either.
We've had other forums here where regime change was indicated, and here you went from a 95% probability to 99.9%. Instead of 12 to 13 times a year at some value that ordinarily you'd see twice that value once in 40 years, you were seeing that number twice that number 12 to 13 times a year. That was a regime change.
Right. I haven't seen yet a model that predicts regime change. Everybody kind of backfits the data very well to regime switching models, but very difficult.
It's extremely difficult, right, to predict those. But I would emphasize that models that do have a lot of conditionality, they are models that use high frequency data and all that, would tend not to pick up necessarily a regime shift. But of course, as the volatility increases, the tail risk will increase. And so, a lot of our clients saw that, the tail risk number is their new normal. And so the TEV number, what used to be their tail risk number is now their volatility number. And so those things change, but models would be able to capture that, more or less.
So just to be fair, there are a couple of questions there. There's a question behind you, Adil, and so there was somebody there. I just got tired. So we'll go to Adil there.
Okay, I have a thought experiment for the panelists, which is that let's assume you had done this reverse stress test before 2008 and 2006, and you were any one of the financial firms out there, then if it had been done well, you'd have found that essentially you were levered like 10 times too much. And the only way you'd survive is you should reduce your leverage by a lot. And if you did that, then all your competitors would have beaten you up and you would have gone out of business anyway. So how does that
Well, there was one firm that did it and succeeded and is still on top of the game, right? So it's not impossible to do it.
I'm sure.
I take your point, right?
Yeah, you can argue all over the map there. But I mean, to address your point, I think this is going to be definitely a regulatory issue because what we had was all the machinery was done to reverse engineering the regulatory procedures, to reverse engineering the ratings and all that. And so everything was based. So let's try to have AAA. Let's try to have it off our balance sheet so that our capital is as small as possible, and so on and so on and so on. And so I think that you're right. I mean, it's the famous word now that when you stop dancing, you're dead. But I think that's going to be definitely going to be the case that we're going to see more regulatory presence there because. Either everybody sticks to that procedure, or it's very hard to implement it on a single institution.
A couple of questions here, and we'll go there.
What always interests me about these conversations is that there's this vague stuff about people making the wrong decisions, but every single parameter you specifically mentioned has nothing to do with portfolio manager decisions. They are completely consistent from one portfolio manager to another in looking at market results. So we could look at the volatility of some stock or some sector in the market. But then when the vague discussion happens, it's always about portfolio managers. Why is there never discussion about specific measurements of portfolio managers' decisions as opposed to measurements of market results?
This is an interesting one. I think, and tell me if this is where you're going, but there's the whole process of valuing the decision versus valuing the result. And I know as when I traded, I never wanted to kind of reward myself or take credit when things worked out. What I wanted to do was kind of give myself the benefit of the doubt or reward myself for making the right decision regardless of the outcome. And if you focus on the decisions which are independent of the outcomes will eventually work out. In the long run. The problem is the only thing, the general world points to the result and ignores the decision completely. And I don't know if that's a completely separate area, but I think it's one of the issues with portfolio managers where their decision, the results that they're looking at are completely independent of the decision-making process.
Well, yeah. I'm pretty sure that Adil and a lot of the people around here who are involved in portfolio management are going to beg to differ, right? Because the entire discussion that happens is on decision investment process and not the results, right? This is a different
Look
discussion.
At all the slides.
This is a different discussion, right?
one parameter that was a measure of decisions in those slides.
This is a risk discussion, right? So, but investment process discussion, this is not a session on that. Goldman Sachs Princeton is a place where Tudor and Caxton and Moore and a lot of successful traders came out from. They did a study early on and found that the success ratio of the best traders trade was 0.6. From all the traders, right? It was indistinguishable statistically from an average of 0.5. But it was how they changed their bet sizes, right, as they were succeeding and failing. It was the investment process that made them successful investors or not. So that's a separate discussion. You have a great point, but it is a separate discussion. here in India, you said.
So when you're talking about a lot of changes, retooling of risk systems in the current crisis, and something people do will just happen during the crisis and then it'll go away again. You know, they're checking risks every day now, but you know, when things finally calm down, they think they know what's going on, it's going to be back to once a month. What changes do you think are going to be enduring?
You want to take that, or what do you do?
I can take. I mean,
what changes are going to be enduring, and also, and how are they going to help avoid issues in the next crisis?
I think, I mean, you're absolutely right. I said that the statistics, the risk models, people jumping on running risk models increased dramatically. Of course, it has decreased over the last couple of months. I think what will endure is not so much how frequently you will check your risk model. It's how flexible and how the risk model will reflect the reality that you see. Because we're still far away from that, right? And I think that every cycle that comes, you're probably getting closer to that. But it's not that now the risk model will be used in a different form. Even taking out completely the regulatory issues that I think will come along, I don't think that it's now because you have a very good model that people will look at it every minute. That's not going to happen. But it's because you have a good model that people will feel more comfortable about the decisions they have to make. I think that, and of course this is asymptotic. This is coming and coming and coming. But that's the way I see things evolving.
So from my perspective, it's an excellent question. If you do a Google search on the new financial architecture, 2000, you get a ton of articles of how the whole financial system is to evolve after the Asian crisis. Right? There's studies after studies, conferences after conferences. Right now, there are a lot of conferences and volumes of new financial architecture. If you compare the two, no difference. Right? So what people have learned from this crisis in terms of financial architecture is pretty much the same as what they learned 10 years ago and 30 years ago and whatnot. Right? What is different though, I think the one thing that actually drove change significantly for us was Miro. And that scared everybody. And there is what seems to be a persistent demand for transparency. And I think that is likely to last.
Yeah, I think people want to understand a lot better how this risk management systems are put together. And transparency is there to last.
One there and then.
So I want to ask the practitioners of the firms that provide risk analytics. You get to this idea of reverse stress testing, and you look at measures like regular sigma or even bar. And what I've noticed with the practitioners and the users is they say, okay, we're good, boom, we're in this nonlinear fat tail region, and then there's chaos. So have you used any measures like one-sided sigma with maybe a negative 5% return, 4% return? I know there's some discontinuities in the math, but things like a one-sided sigma and the resulting Sortino ratio instead of the Sharpe ratio, so that as a portfolio or as a dynamic start to go bad, you can sort of see the process and feel the process on a day-to-day basis. Does that make any sense to any of the members on the panel?
Sure. I just got conditional water.
I'll make one comment on that, though, in reference to the reverse stress testing part. And stress testing in general doesn't take into account distributions. All it's focusing on is what a loss level is relative to a particular shock. Whether you start with the shock and get a loss, or that loss get the shock. So we're not even addressing the probabilistic question.
So you're trying to push that in a micro level and bubble it back up. That's
and then, right. So the first, we're saying is, will this kill me? I'm not saying what's the probability of it killing me. I'm saying what event, given this event occurring, what kind of damage will it do? And that's very different from making any type of prediction about the probability of it occurring. And that's where value at risk or any other distribution assumption, Monte Carlo type analysis would come into play. That's not to say that the assumption or what you're talking about, focusing on the one tail event or the tail on one side of the distribution, isn't an appropriate way of looking at it. I'm just making a comment. I mean, you started out saying in terms of reverse stress testing, and I think that what your question does is it highlights the distinct parts of the risk management framework, where one question is specifically focused around what damage will this do, and then the other question is focused around how likely is this scenario to play out, and they're two completely different questions.
But what I'm trying to get to is how do you get the essence of this dynamic on the dashboard and on a daily basis or in a near real time enough basis to where an appropriate decision could be made by the user, at least in theory. That's the idea.
Okay, and again, what I'm talking about specifically with reverse stress testing is if you identify these threshold loss levels or identify the vulnerability, you know where that risk lies. You don't know, you know where that threshold is. You're not making any assumptions to the probability. And once you get there, you already know that you've hit that. Once you hit that point, you've got a decision framework already in place. I understand what you're getting at, and I think that's a separate form of analysis that is probably also appropriate and an interesting one, especially considering what we've seen now, because people have been once they're in the situation, what do they do then?
Well, you're trying to get the essence of, as I approach the strike price of the call option, then it's going to behave very differently than it's way out of the money. So what you're trying to do is, as you approach that breakdown point, maybe you give the risk manager a couple of days warnings that they can adjust their liquidity situation in various scenarios like that. That's what I'm trying to get to.
Well, but those things are standard, right? You just if you have options, you just do delta scenarios, right?
Well, I was just drawing an analogy with an option. I wasn't talking about options per se.
Right. So I think whatever comments like Ron made for reverse stress testing, they're true for general kind of historical scenario testing as well, right? Because you're just bootstrapping from the historical data, given your positions. You're not making any distributional assumptions. So that's one way of getting a handle. The other way of handling is that you look at your factor sensitivities and then shop them, which is what people do, right? And so, okay, what is my lecture going to look like if everything is against me? So, and the third, in the parametric world, you just look at conditional VAR at different points, right? So what is my 80% conditional VAR? What is my 95% conditional VAR? And that will give you some idea of what the loss is likely to be when there is an extreme loss.
I mean, but there is a lot of research on the asymmetries that you are referring to, right? We have research on risk models that are nonlinear, right? Let's say, for instance, an equity risk model that instead of having the usual distress parameter or factor would convey information from the credit markets, for instance, a default probability. And that that if the default probability goes from 0 to 0.00, it doesn't really matter. But it's on the non-linearity when that default probability starts to pick up that then you say yes, this is distress risk. So there is a lot of research around that. There is a lot of research around how the volatility forecasts evolved on an up market or a down market or something like that. That's definitely. The problem then is how you integrate that into a framework that makes sense.
So one question in the back, and then we have one here. So after this two, maybe you have time for at most one question. We'll wrap up there.
All right, I'm going to give you guys a break and ask a very non-technical question. Very simple. Just there's so much emphasis on risk models and all that stuff. So I guess I'm just curious, with this crash and with this market domain that happened over the past few months, has there been any study done in terms of consistency analysis across different firms? For example, I know some models are very standard and very basic, but then each firm has sort of proprietary models, risk models, which show you different numbers. So Antonio, what you see at Barclays, for example, versus what Sandeep would have seen at JP Morgan. Have you learned any lessons from that? Like, the risk numbers are so different that this person suffered a bigger loss because of that. Because I know it is the firm's property or proprietary models, but still I think there are some lessons to be learned that there should be a bit more exposure, a bit more clarity in terms of how the risk models are being built?
I can talk to what happened at Barclays, and it's a little bit what I was referring to be close to the market. It's a complete two-way door, but where people understand very well the assumptions of the models, and the assumptions of the models may be different, and the roles of the model may be very different. For instance, in Point, the software that we have, all the analytics are coming directly from the desk. So if you're talking about the prepayment duration, if you're talking about a vega on an option or something like that, it's exactly the pricing models that the traders are using, right? We do have, for instance, on our new equity model that we released last year, actually, for an historical curiosity, we launched it on the weekend that Lehman went bankrupt. And of course, we were part of Lehman. So at least we have a very nice, complete out-of-sample period where we can test the model. We're happy with it. But we have, for instance, several of the equity desks using literally our model. I don't want to emphasize too much that point in the sense that they are using it. They are using it with other more high-frequency trading kind of models. Our models tends to be not for the specific trading desk. It would tend to be more for an asset manager, for instance. So they take information from it. It just doesn't mean that they're going to scrap whatever they have, or it doesn't mean that when they use our models, we should scrap whatever we have. We understand very well. We talk a lot about it, and we make our own decisions. The same thing, let's say, regarding default probabilities. Our credit desk may have a different assessment about default probabilities for the next 12 months than our risk models are predicting. We understand the differences. We understand the idiosyncrasies around those differences, and we move on. It's not that one model is better than the other. We know very well what our models are doing and what is the purpose, and we just want to make sure that the purpose is in coordinates with what our clients want. So there is no contradiction there. Sorry about
So it's a great question, right? So at micro level, people do study for the asset class or the instruments that they are most interested in. They go to different brokers, get the models, and see how they compare. So one example is a study that Masood Haidari did on the OS models. He's a mortgage guy, right? Across 7 different investment banks. In comparing them, how the OS models differ. So there are all the inherent assumptions on the interest rate simulations, prepayment models, and whatnot. At a macro level, though, I haven't seen anything that compares how, for example, Axioma or Riskmetrics or Point, if I give them the same portfolio, how would that beta estimates differ, right? We long wanted to do that, haven't gotten around to that. The key risk that you're identifying is the allowance of investment banks, right, to mark their own risk. And this happens to be the Basel kind of, and that is just, yes.
Yeah, my question gets back to the what I heard back there, will this kill me or what will kill me? And if I were a client of Bernie Madoff, do you have any stress testing or reverse stress testing that would have flushed out that fraud in some way, shape, or form?
Yeah, we have the fraud identifier. You haven't used that?
It didn't work over there.
Yeah. Well, actually, I think there's a lot of lessons to be learned from that one. And I think, first of all, though, the fact is when anyone who was involved in any type of due diligence would recognize that it's not that they didn't know that they didn't do a couple of due diligence steps. They didn't do any of them. I mean, it was literally they ignored all the basic primary steps of due diligence. And what's interesting is that had you done any one of those, you wouldn't have invested. And there's a long list of potential investors there that didn't invest specifically because of any one of the inconsistencies. But what I will say, what's interesting since then is over the last year, there's a lot greater focus on ongoing due diligence. So whereas due diligence used to be something where people spent a lot of time going over the books, talking, to the administrator, talking to the portfolio managers, and that's before they made the investment. What we're seeing now is that now that people are interested in ongoing due diligence, where they're actually going through this process on a regular basis, and they're going back and questioning some of the, or I should say, making sure that the investments that they've made over the last few years, over the last decades, are actually consistent and continue to follow their their best practices. So that's certainly a big change in the investment process, where due diligence is not just one and done. It's an ongoing process, and it takes a lot more work, but it's probably best.
And what's actually, just to follow that point, right, what's emerged as clients are demanding more of custody and on a daily basis an understanding of a hedge fund manager's risk. So that requires you looking at position, translating into risk engines, and independently verifying, understanding the risk. So whether the bet turns out to be true or false, right, whether the risk kind of pays off or not, that's another discussion. But with the comfort people are getting from that kind of analysis is not as much as understanding the risk correctly, but at least somebody else overseeing and custodying the portfolio.
I mean, when talking with clients and at other conferences that I attend, it's pretty clear that what change is there, or if there is any change from the more sophisticated clients, probably not. Is that if you really want to understand what is the process, right? And you're not concerned so much. Of course, you would prefer not. But you're not so concerned if the process fails, and so if you have a negative return, as long as you know why you're getting that negative return. I guess Madoff never had a negative return, so you wouldn't get into that. But when you see a straight line, it's probably a good indication of something going bad.
So there is this concept of too good to be true, and you got to be really careful when you invest with guys, right? So Madoff version, iteration of investment returns was just promise people 12%, 16% common clip, right? So now a lot of people have gotten wiser to that kind of steady returns. So the new breed of managers that you got to look out for would have some negative returns. No, and it's true, right? But when you look at different period returns, and we have a manager every year, annual returns are within 12 plus or minus 10 basis points. Every worst month was 3.69 or 3.7 and negative 3.7 or something. And you look at that data and ask, like, as my partner likes to say, this kind of data doesn't just occur in nature.
And I guess to that point, a lot of recent interest on very flexible return attribution, for instance. And I think part of that is because people want to understand. I'm putting money with you. You told me this is going to be the strategy. Now let me check. And even if the news are good, but you're not sticking with your strategy, your return is not coming from where you're saying it should come. Then it raises a flag.
So with that, thank you all.
Outside, please, Thank you.